Amazon just delivered its quarterly earnings, and the numbers were stronger than most analysts expected. Yet, the stock still dropped more than 7% in after-hours trading. At first glance, this seems confusing. How can a company beat expectations and still lose billions in market value overnight? Well, as with most things in the stock market, the answer lies in the details. In this breakdown, we're going to look at exactly what Amazon reported, why the market reacted the way it did, and whether this dip could be the buying opportunity smart investors have been waiting for. Let's start with the headline numbers. For the quarter ending July 31st, 2025, Amazon reported net sales of $168 billion. That is a 13% increase from the same period last year and higher than even the most optimistic projections from management. This is impressive, especially considering the global trade environment hasn't exactly been friendly. Tariffs on imported goods have been rising, supply chains have been facing disruptions, and yet, Amazon still found a way to grow double digits. That's the kind of resilience you want to see in a long-term investment. One reason Amazon has been able to maintain momentum is because of reduced competitive pressure. Over the last 2 years, companies like Temu and Shein have been aggressively targeting online shoppers with ultra-cheap products and sometimes outrageous cashback offers up to 20% in some cases. For a while, these deals lured away price-sensitive customers from Amazon. But then came the changes to the de minimis import rule and significant tariff increases on low-cost imports. Almost overnight, Temu's marketing became less aggressive, cashback fell to around 4 to 6%, and prices crept higher. This narrowed the price gap between Amazon and these discount platforms, making Amazon's offer more attractive again. But Amazon is not just about e-commerce. Its crown jewel is Amazon Web Services, or AWS, the company's cloud computing division. AWS grew revenues by 17.5% compared to last year, and that's slower than Microsoft's Azure and Google Cloud, which are both growing close to 30%. But AWS is still the leader in market share and profitability. It operates at margins above 30%, and those profits fund many of Amazon's other ventures. From expanding its logistics network to investing heavily in artificial intelligence infrastructure, if e-commerce is the backbone of Amazon, AWS is its profit engine. So, with strong sales and solid cloud growth, why did the stock take such a big hit? The main culprit is forward guidance. Amazon told investors to expect between $174 and $179 billion in sales next quarter, which is fine, but operating income is expected to be between $15.5 and $20.5 billion. That midpoint is roughly flat compared to last year's $17.4 billion. For a growth company like Amazon, flat profits can make Wall Street nervous. The reasons for this cautious outlook are worth understanding. First, tariffs are squeezing margins in the short term. Even a giant like Amazon can't absorb every extra cost without feeling some impact. Second, Amazon is in the middle of a massive investment cycle. This year alone, it plans to spend more than $15 billion on artificial intelligence data centers, model training capabilities, and next-generation logistics. These are big-ticket expenses, and while they should generate returns for years to come, they show up immediately in the expense column, depressing current profits. Before these earnings came out, a fair value estimate for Amazon was around $243 per share, compared to the market price of $234. After the 7% after-hours drop, we're now looking at an even bigger discount. Here's where investor psychology comes into play. When most people see a stock drop after earnings, they assume something is fundamentally broken and rush to sell. But experienced investors know that the market often overreacts to short-term challenges. If you believe Amazon will be bigger, more profitable, and more diversified 5 years from now, wouldn't you rather buy those future earnings at a cheaper price? Amazon's long-term advantages are enormous. It has one of the most sophisticated logistics networks in the world. It's making same-day or next-day delivery possible for millions of products. Its Prime membership program locks in customer loyalty not just for shopping, but also for streaming, reading, and other services. AWS continues to dominate in cloud computing, and the company is expanding into high-margin areas like advertising. And now, with billions being invested in AI, Amazon is positioning itself to lead the next wave of technological transformation. Yes, the short term will be bumpy. Profits may not grow much over the next quarter or two. But history shows that Amazon has a pattern. It invests heavily, sacrifices short-term margins, and then reaps huge rewards later. We saw this with their early e-commerce expansion, with the launch of AWS. And with Prime, the same playbook is likely happening right now with AI. So, my final take is this. Amazon is still one of my top 9 stocks to buy in 2025. The market's negative reaction to otherwise strong results could be a gift for patient investors. As always, do your own research, make sure it fits your strategy, and don't let market noise distract you from the bigger picture. Sometimes, the best buying opportunities are wrapped in scary headlines. This might just be one of them.